Yes. So this is the plan for the talk today. I am going to be discussing. The goal is to talk about what can you do with Vix Futures, right? So it's two talks, two papers. One's trading signals in Vix Futures, which just appeared, or is at least it was posted on Archive, and hopefully it'll appear in some journal. And so the idea here is to put yourself in the position of someone who wants to make money, or to 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 uh, to profit from perhaps opportunities in the VIX futures market as a whole. Essentially, trying to do something like the Merton model, the investment under uncertainty, where you have an asset, which in fact it's a term structure of assets, futures, and you have, you want to position in these assets. And just assuming that the underlying structure is Markovian, doesn't, it's an assumption just to be able to make some calculations a la Merton. Uh, we don't really, we have, however, also worked on the data and on fitting a curve model to the data. And this is done in a previous paper. And so the idea is to begin with a previous paper so that you know what I'm talking about when I talk about the Markov, what we call the Markov model. We assume that the term structure follows the Markov model. In fact, it follows our own Markov model. And we developed this in 2018, a long time ago, and we had several attempts at publishing, and I think it eventually got published somewhere. And this paper came out of saying, well, what about now? What can we do? And so can we use end of day data, or more historical data, and position like an investor in the futures market, like perhaps like a CTA, shall we say, a commodity trading advisor, someone that is investing clients' money in volatility futures. So our business here is volatility futures. So I want to cover two things. First, a little bit about volatility futures and a little bit about the model. And then after that, how do we carry out this in program in practice? And this will have some back testing, okay? Back testing is a very, very bizarre art because it's empirical and it's also very in sample. If you like, you have to avoid in sample. But then we also were able to run it in 2021 through the GameStop event, and we just ran it, and we'll tell you what happened. I'll leave that to the end of the talk. So the talk is really ends with a paper trading of about 3 months on investing in Vix futures, where we try to be as close to the market as possible and had no illusions whether it was going to work or not. And so it turns out that this is what we're here, what I can tell you today. And this talk is a joint work with Andrew Papanicolaou, who's now a faculty at North Carolina State, and with Tom Lee and Jeff Wang, who are respectively at New York University and at Columbia. they're, I believe they're postdocs, or they graduated, or they're about to graduate. And so this is a hybrid of a little bit of theory, a little bit of modeling, and even some data science by these collaborators. So that's what I wish to cover. And in order to arrive to the final paper, I would like to spend a few, perhaps 15 minutes or so to be able to discuss VIX futures and what we know about VIX futures from the data and from fitting the data to a Markov process. So please feel free to interrupt me or to do whatever, ask questions, that's fine. And so briefly, we will start with an index, well, the CBOE implied volatility index, or VIX, which comes itself from the variance swap model from Whaley from the 90s, which is a model where you would look at the implied variance of a 30-day S&P 500 market based on the options, the 30-day options, usually out of the money options, out of the money puts and out of the money calls. This is what this notation is. And this was done by Whaley, and then it became an index which is owned by CBOE, and it's called a fear gauge because it goes up when implied volatility goes up, and everything here is about the S&P 500 index, and these options are options on S&P 500 futures. So this is the chart of the VIX. We've seen this many times for the index, and we also know a lot about its histogram or its probability since it's being created. And most of the time, what this index has is it has fat tails because most of the time nothing happens or few things happen. So the VIX is in a dormant state. It could go, usually its mode or its most likely state, you'll find it in the teens, in the 14, 13, 12, etc. Its average though is 20. It's 20 because there are moments that it spikes. So the average is bigger, goes up. And this has to do with the fact that VIX is very volatile. And that's what's called a fear gauge. And we have some descriptive statistics that say what I just said now. The median, the mode is 11 and the mean is 19. And this can actually be identified with the typical value of a VIX futures contract in the short term versus the long-term value of the contract, which is more in the 20s. We'll get into that. The question is it stationary or not? Well, depending on where you look at it, if you apply something like one of the classic statistical tests, and now you have the VIX futures. So when we talk about VIX futures, we are going to know that the tick size is 5 cents, but the value is 1,000. So basically, you're dealing with something that now is the notional contract is about 20,000. So it's VIX times 1,000, and it settles settles monthly. So you have, for example, here, this is the current period covered by the VIX index itself, 30 days. And then you have the first contract, the second contract, et cetera, et cetera. And all contracts should settle on the VIX on the settlement date. And everything is cash settled. And some weekly settlements have been added as well, recently, as well as weekly S&P options, which is convenient. So this is, if you look at the curve, this is what the curve looks like. And this position here is what's called it's a nice curve. It's called a Contango curve. So you see that the front month, it's from another time, but the front month is lower, and then it goes up and up, because here you're basically setting the horizon. The market makers are setting the horizon to values that are more related to average value, whereas here this is more or less observable to the implied volatility of the S&P options, right? And those S&P options depends on the supply demand. So if nothing's going on, these short-dated futures, are not that expensive compared to the long term. And this happens particularly when the market is nice, correct? Because that's when there's no interest for short-term insurance against the S&P, say portfolio insurance, if you like, or you can call it that. So basically what we have is an increasing curve, and it's called contango. So here's a curve. Here's the curve. If you connect dots, these are the weeklies. So this is if you like to look at the futures on a fixed frame. So rather than looking at by expirations, you can look at that. You can count the number of days, that's a convenient way because you can do statistics and see what the curves are. So this is different examples. This is fluctuations around European elections a few years ago. This is the famous October, famous Lehman Brothers crash, where the volatility was around 80, but the VIX. So, but these are just the futures, and you see the futures went up to 60. Just to give you an idea, short-term futures were also around 60 during the events of COVID, but I don't have the data here to show you. And this would be this black line corresponds to how the curve moved 2 months after Lehman Brothers. So that means that as you see that the world is not coming to an end, then the value of insurance drops dramatically from the blue line all the way to the black line. So the front is very volatile, the back is less volatile. This is a feature of this market. So, we can do we did a lot of statistics on this PCA. I want to go a little faster here. And basically what we conclude is that there's a most likely curve that you will see, and then there's a mean curve or an average curve. The most likely curve, if you put all the contracts, is contango, that means it's increasing, but it's much less than the average, which means that this is actually the boring state. This is the average of what happens over a certain period of time. So you see that most of the time, the markets are quiet, but you see quiet markets, but all of a sudden there's a lot of volatility coming in. All right. So one of the things that we found out, let's see if I need to say anything about the futures. Yes. No, I have everything I want here. Yeah, I want to tell you about the model, and then we're going to go back. And so we found that VIX ETNs, so for example, one idea is how do you treat VIX ETFs, which are rolling futures contracts. We're going to go that very briefly. But if we want to quantify the profitability of any future strategy, including shorting or going long via VIX ETNs, we need to have a model that has at least two factors, because one factor is very rigid. One factor makes it that everything is kind of moving in parallel up and down. Of course, at the beginning, it's going to be a little tilt and the VIX is going to drag everything up. But of course, if things get more dramatic, then VIX will overshoot the long time horizon, and then there's going to be a reversal. And that's perhaps the simplest dynamics, but in order to make money or in order to try to do better than a one-factor model, we chose to do a two-factor model, two-factor log normal model, because we also know that there's a lot of wiggles in the curve that appear, and we don't want to have a one-factor model would have no wiggles. It would either say there's contango or backwardation, but it doesn't show you changes in the curve. So for that, we're going to use a log normal. We used a log normal two-factor model. And the log normal two-factor model is kind of the easiest model. You assume that VIX is driven by two Gaussian processes, two mean reverting processes. We know VIX is kind of mean reverting. I mentioned that. So we could try to fit VIX to the parameters of, say, Ornstein-Uhlenbeck processes, but we also know that this is a derivatives model. So we also have to fit not only the VIX, but we also have to fix the VIX futures. And the VIX futures, as we know from financial theory, they can have a market price of risk. Just like in the papers of Cox, Ingersoll, and Ross from the early 80s, 1982, there is an adjustment to be made between the P measure or the historical measure and the pricing measure. And that's something that we all know how to do, and we do it like everybody else, except that we do it for this data set. So that's why, it's convenient to look at what we call constant maturity futures. So this is a future expiring later at some days away from now. And so we are going to, the theoretical formula should be some kind of expectation function, expectation value of the VIX, but the VIX, our VIX model, but under a new measure called the Q measure, or the measure with the market price of risk. This measure, this is an old scheme that everybody uses in derivatives, and it allows you to pass from the statistics of the underlying asset, which is VIX, to a risk factor. You have to consider a risk factor, and this is why we actually allow ourselves to change measure in the Ornstein-Uhlenbeck processes. So we have the mean reversion rate, and for each factor, one would be the long-term factor, and two would represent more the short end of the curve. And you have rate of mean reversion. And when you have an overline, that means that it's the Q measure. It's the one that we estimate also using the futures curves, right? So the basic idea of building the model is to use a log normal for VIX with two factors, but also, which is very easy to explicitly compute. I know this looks horrible, but that's why we have computers. And so it says that the curve, as a function of the time to expiration, is going to look like this. These parameters all need to be estimated. Both the K's, you need to estimate the parameters for the Ornstein-Uhlenbeck, but also the renormalized parameters, as did Cox and Ingersoll-Ross, for those of you who are old timers and know enough about this to know that when you fit, say, a term structure of interest rates or term structure of any futures, there's an adjustment because the futures trade, and so therefore they should not be you should use not the historic measure but the adjusted measure, which is represented by the prices. So once you do that, you can actually estimate the model, and we did it, and you get some, for example, over different data, you see how you see here the long term, the short term. Long-term volatility is 55% annualized. Short-term volatility is almost 100% annualized. So that means that VIX is very, very sneaky, very volatile. But if you go away, to the middle of the curve, or say a few months out, you see that would be represented by the second factor. You would get something a little slower. So these parameters are the ones. So these parameters wildly depend on how you use them. And so you can determine some sharp ratios and so forth. The main conclusions of this paper are the following. If you use this model and you look at investing in a 1-month ETN or a 1-month futures roll with such as VXX using VIX Futures, then what you typically find is that there's a downward, the average is decreasing. That means that there's decay in the 1-month ETN, and on the reverse ETN, and you see that things point up. That is because of Contango, because because investing in a constant maturity futures 1 month out will make you lose money because the curve is increasing most of the time. So that future will converge to VIX, which is less, right? So you're going to go from a 20 VIX at 1 month in the future to a 12 spot. And that is why this goes down. And actually, over the period that we did it, which is over here from 2010 to 2016, you see that the actual trajectory that was realized is downward sloping, but it's actually depends. It depends on what happened. And, so this is just a model. The Markov model is just a model, and it tracks the VIX ETN, but it doesn't, there's a lot of leeway here, and, only one path was chosen by the market. So this is the talk. So what do we want to do now? Well, we have this model. It seems to predict, among other things, it is consistent with the idea that going long VIX 1 month ETFs, for example, by the reasons I explained, would be a losing trade in general. Although sometimes, on some extreme paths, it actually makes money because the average is over here, but there are things that are much better than the average because the model also takes into account. Uh, it's a statistic. This is Monte Carlo simulation. So everything in color is Monte Carlo simulations of trading strategies. The actual trading strategy is in black. This is the Monte Carlo simulation using the model. You see how they go in the same direction, but only one trajectory is taken historically. So if you're trading, you can use this to produce signals for you, but you have to also have an expected utility and so on. You have to do something in order to not to lose too much money, you know. And this is what in the next paper, what we're going to do is we're going to try to use our Markov model calibrated to actually trade VIX futures. Because if we do that, that's kind of nice because it allows us to, for example, to see whether there could be CTA strategies which are not super high frequency, which a lot are not, where uh, you're basically looking to see what is the effect of the shape of the curve on possible investment strategies. Investment strategies should not naturally move from one future to the other if you're trading for more than 30 days. So therefore you will have to roll, yes. At the same time, you will have uh, to mark, you have to therefore change, that if you roll futures and nothing happens, and there's no, then volatility goes down, uh, you know, then you're in the back. Sorry, if you roll the futures, then you lose by contango. So should we? How do you make money selling volatility or buying volatility? The idea that it's backwarded says you should sell vol, but the idea that it may revert says maybe I want to buy vol. So you're back in the old paradigm of volatility traders. What should I do? Buy vol or sell vol? Sell VIX futures in the front and hedge by buying. Well, we also know that, but it's not here, it's in the next talk, that uh, maybe you should sell some futures in the front, that means in short dated, and buy to hedge with futures in the back. And this is essentially, and roll this whole thing in time. So this is what we are trying to do. This is what the new paper is. It's a first attempt of actually using the ideas of portfolio dynamic investment in portfolios with using our model VIX as making believe that VIX is what actually happens, compute the strategy. That's not as easy as you think because it's a very high dimensional problem. And then see whether that matches what a trader would do and to backtest the strategy by actually trading through it. And this thing could have transaction costs. Um, and so basically, for example, you would say, no, my strategy is to sell. So I want to sell the VXX short term and just ride it out. Well, you will get terrible results if you go through 2018 when there was a huge volatility spike, or many events that occur that wipe you out. So economically, it doesn't make sense, even from a capital point of management of capital. So you have to be able to go long and short. And so our idea was to based on our Markov model to come up with an investment strategy. Uh, and so we say a new approach for trading VIX futures. I would maybe be a little more modest and call it a Merton type approach for trading a multivariate futures. But also there's a lot of things going on because we're moving from one futures to another. As they expire, we have to keep going and changing them. And I'm going to show you a trick that allows you to do that quite nicely, conceptually speaking. And well, so the results are encouraging. And so I think they're encouraging. And I also, this is the most recent work, which was done just about finished very recently and done. Most of the new work here, which was not writing the paper, which was done a while ago, had to do with events that happened in 2021 and late 2020. So this is, so paper two is now we use our fitting of the Markov process for the VIX. We want to use it for investing. I have here 12:59, so 1 o'clock my time. So I assume I have 50 minutes I need 50 minutes to do this part. Okay, all right, good. So any questions so far?
Actually, there's no questions in the chat right now. So actually, to answer your other question, you have anywhere between, you have up to 30 minutes from now, but you don't have to take the whole time if you don't want to.
Yeah, I see in the chat that people are asking me for the presentation, which is a very, very flattering thing. And I'll try to do that after this is all finished, or leave one with Professor Pearson and Professor Muryayev, and they can take care of, they may or may not share it with you. Or you can send me an email and I'll do it. So, okay. And there's a link to the paper. Thank you.
Yes.
You put a link to the paper. And this is the most recent paper. But there are other papers. If you look in those references, you'll find the original papers on the Markov model. And the Markov model is nice because in order to do the Markov model, we had to test something. So we tested essentially shorting volatility ETFs. My background is in exotic ETFs, among others. One of my interests driven by futures or leverage, all that sort of thing, and inverse. And so I always taught myself to look inside the ETF to see what it's done exactly. And in this case, these VIX ETFs are supposed to do dynamic strategies. So I said, perfect. Let me do that. Okay, so moving on, we are going to introduce this paper. So let me skip this part. The idea is that the shape of the futures, VIX futures, is informative. It shows that its shape is likely to persist, more likely to not for only a short period of time. So in other words, that it's going to revert to something else. That it's it's a bit unusual, right? Either because it's backwarded or because it's backwarded in the middle, or there's something that makes it non-monotone, or it's completely backwarded or partially backwarded. So in those conditions, what should I do as an investor in the VIX futures complex? Well, what I can do is I can use the stationary VIX futures curve model, which I just talked about, and I try to pick a utility function, and then and create a trading strategy that is over acceptable strategies, right? Acceptable strategies, which I'll now describe, maximize my utility. So then I go back to the Merton context. It's a little more complicated because, what exactly am I investing in? Obviously, I have to use some kind of constant maturity futures because that's how the model was first, because that's a natural time frame, the natural description. So we have to maximize, and there's going to be a set of admissible strategies that I can use. So to be concrete, I want to sample, I want to maximize my utility among for a portfolio which is a vector really it's a vector of actions in some space of actions, and this will be described now. And the idea is to come up with what's the clever thing to do in this case, based on the fact that I have my toy Markov model and I have to maximize utility. Problem is it's high dimensional. There's no way I can compute that. And I'm gonna, even if I use very one or two short dated utilities, it's complicated. Maybe we should simplify it even further so we can compute it explicitly. But my collaborators came up with another idea, which is also good, I guess. And that idea is going to use machine learning techniques to learn the expected utility and its maximization. So this is kind of now we're giving a nod to the younger people that work in data science and trying to use it has a lot of data science. Obviously, this is my collaborators' interest as well as mine. So the idea is that you have the Vix Futures curve. The idea is essentially to maximize utility over a set of strategies, possible trades or actions, and it's vector valued because you have one for each future. And then you look at the utility one day ahead, could be more, but you just look at it. You look at today and you look at tomorrow's curve, how it moved, and its expected utility, and that's one possible way of creating an investment strategy. So here is another more precise graph of the VIX futures, how they work. You know, it's in normal conditions, it's contango, but when there's a shock in the market, notice that the y-axis is much bigger. You have, and this is on November 2019. I don't. So this is November 2019 here, and this is March. So this is the curve right after COVID, or actually before COVID, because the spike was really, the bottom of the market was on March 30. So it is showing already that this curve is the risk entering into the demand for volatility, increased as we got into COVID. And this is kind of in November of 2019, the future looked bright and we have an increasing curve.
Can I ask a clarifying question before you go much further?
Please.
So do you allow for transactions costs in the optimization?
Yes, we do.
Okay, so this is why it's high dimensional problem.
No, it's not. Well, it could be even, actually what we do is we know that there's transaction cost because the market is 50, it's a $50 tick on let's say on 1,000 VIXs, which is right now around 18,000, but it adds up. So if you don't take into account transaction costs, is bad. This is later in the paper. We're going to discuss that. So because I'm working with academics, we did two things. First, we did it without transaction cost. We were golden. And then we put transaction cost, and we realized the point that we were no longer that golden, but we quantified that by charging ourselves every time we made a trade, the bid-ask spread for crossing that, on the number of contracts or how we went from mid-market to the new bid or the new ask. So we charge ourselves. There's a formula here, Neil. That's a great question because that question slowed us down, put it that way. But we have experience in this because we did not really have the tick data to have. So what we did instead is we just running over this very quickly to the part that you're interested in, which was actually the crux of the matter, because it's the difference between making no money and making money. What we did is we use a formula for transaction cost, and its transaction cost is equal to the futures times a percentage, the notional futures price times a percentage, the maximum of that, and 5 cents on a 5 cents on the VIX, right? So $50, right? So this is, Neil, this is the formula that we use in the simulations. So every time we made a trade, we charge ourselves epsilon fi, which is about, it's a number that when we do have in basis points, we use a basis point number. So 20 basis points, 30 basis points, or 40 basis points. The typical number that you're looking for here is around 20 basis points in the VIX, if I'm not mistaken, and per trade. And this solved a big problem, which is not to have to deal with high frequency data, which of course we're dodging it. But basically, so we say the return on the portfolio is going to be the return without transaction costs, financing, of course, and then here, transaction costs, because we're doing a delta B, so delta P, so we're doing it like this, and then we're doing it times something that is basically, we're charging ourselves from midpoint, so that's why there's a half. We're charging ourselves, at least, a certain amount of basis points or 5 cents. And we have some tables around that. Are they here? They are. Here are the typical thing. For example, if you look at different folds, that is different time periods, different training levels, you have zero transaction cost. You have like Sharpe ratios that are, hallucinating, like 3.7%. But if you put 20 basis points, it goes to 3.7 Sharpe ratio. Then 3.4, 20 basis points, which is more like it. It's like, it's still high, but we can actually look at the reduction in performance as a function of the and this is these are, for example, sometimes you see that negative Sharpe ratios as soon as you hit 20 basis points. So that means that we can actually, if we're honest with ourselves, and we try to be, I learned this back in the old days when I used to trade stocks for a fund, and I used to use the same equation that is, this is a good thing for academics nowadays. Before, it was all we had because we use end of day data. So what we do is we have to charge us something, and we used to charge us this parameter, which is how many basis points do we add of transaction cost given the size of the trade. And this is, if you don't do that, you end up always making money like a champion, or like someone once said, you get tired of making money, of winning. on a more precise, then it's not so much. Neil, is this okay for you? Do you?
Sorry. That was a longer answer than I expected. I should let you go on.
What I said is I tag on 20 basis points to every trade. And I do it from mid-market. So if you give me the mid, which is what my data gives me, I'll just charge myself 20 basis points. I will cross a bit. I will cross half a bid spread. Okay.
Mm-hmm.
That's the poor man's. I do either that, or I have to get like an incredible amount of money. But the simulations that I do for 2021 are done with actual paper trading, paying for the whole price of each trade. So they're more, I actually buy at the ask and sell at the bid. So I am, I do not give myself any possibility of avoiding transaction costs. I take that because in the real data, we were able to get, we were trading in the market, but paper trading. So Neil, that's the answer. The answer is definitely you have to put something. You either charge yourself a percentage of the notional value of the futures, which is about 20 basis points, or you actually take data and find out and actually go and trade and quote, but that's very expensive. And we didn't do that. We just did some end of day trading, and we actually paid, we looked at the market open, what the real market is, and we did that. So we have three types of solution. Do nothing, which we obviously ignore. And then we have the other solutions, which are to use the tick data, to use the actual data, or to use basis points, estimating by basis points. Good. Now we are going to do, we're going to go into the, we're going to come up with, we said, okay, how do we do this? Since we're going to be trading across expirations, let's look at a portfolio of rolling VIX, right? So rolling futures contracts. So that means that we move into a frame where what matters is the shape of the curve in terms of the slope. So you look at at the curve, and of course now we're simulating, right? So we're simulating this to come up with trades. So this is basically the idea that we can come up with a stochastic differential equation for every rolling futures based on our Markov model. So if we do that, go through a lot of things. This is part of the old. We can get rid of this. So this is how you construct the signals. You come up with the return on every. This is all based on Monte Carlo simulation, correct, of our model. So this is a return for a particular action. And this we already showed you before. And then you basically maximize this and computing the trading signals, right, using, so we train the model, if you like. We can talk a little bit about that because we need to, yeah, so the data were used from, yeah, Vix Futures. So that, we got this data from Vix Central, which is a website, and then we simulated, we backtested for Vix Central and with our model and see what happened. And so to make it easier to do it with the neural networks approach, we don't really solve this problem in continuum, but we rather focus on 5 actions. Do nothing, short the 1 month, short the 1 month and go long the 2 month or the next one. We're actually going to work with specific, 1 month and 5 months. So we short the 1 month and we go long the 5 months roll, or we go short the 1 month and go twice the 5 months. And the other possibility, which is essentially contract neutral or 1 to 2. The reason why taking 1 and 2 is because it's known from traders that the 5 month volatility is half the 1 month volatility in the futures. This is, many people have traded this 5 years ago or something, or a bit more than that, as a way of hedging, selling the vol, short-term vol, by buying long-term vol at 5 months. And not surprisingly, there's a 5-month ETF called VXZ. So we have VXX, which is If you think about it as that you're trading ETFs, you have the 1 month versus the 5 months. And you can actually go short to 1 month, you know, and here you can go, you see the amounts are different because these are natural hedges, 1/2. These are not, but they're dollar neutral. So that's another candidate. And we're going to look for strategies that invest in these rolling strategies. So to simplify the neural network, rather than doing the entire, to make it easier to compute, and then we're going to backtest that. And so forget about these things. The result is the following. The result of doing this, computing these strategies, explained in plain English, is that you're basically looking at the Vix state, the log Vix, and then here 1 month roll. So that means 1 month slope of the curve. I mean, so you're looking at the spot Vix today, and you're looking at the 1 month slope. And given to where you are in this phase diagram, for the lack of a better explanation, it tells you which of the 5 strategies you should use. You should buy the 1 month, sell the 5 months, sell the 1 month, buy the 5 months, here times 2. And we actually, by neural networks, found that these optimized, we're optimizing the expected utility, right? So the idea is that we go from futures to rolling futures, and then we pick from rolling futures. That means one, and then from all the possible rolling futures, we go on the 1 month rolling future or on the 5 month rolling future. So on the front of the curve or in the middle-ish of the curve. Once we do that, we create possibilities, all the possibilities that you find here, plus a do nothing possibility. And we maximize we actually compute based on training the model, if you like, and based on based on our Monte Carlo model too, on our Markov, we compute these regions here of actions, of what to do. And then the whole thing is now is converted into performance over different historical periods, which are out of sample, I hope. Then you have transaction costs, put in some transaction costs. And here's where I talk about transaction cost. And this gives us the end, pretty much what gives you some nice simulations. Not that great, but not bad at all. I mean, it looks very good, but this is all paper trading. So maybe we're over here, right? We're not this strategy here. These are different, but it doesn't matter because at the end of the day, we're going to do one more on this. We're going to look at it, out of sample by, we're going to do it out of sample by, and this is the end of the talk, by looking at what happened in 2021. This is my favorite because I always like to do the latest thing, but so I have actually we looked at the entire campaign from February 22, 2021 to April 6, 2021. And this was paper trading based on marks at close, but also not prices at close, price when the market was open, paying the bid, paying the offer and selling at the bid, using these strategies. And this is what actually happened in practice. We started out a little bit flat and we made about 5%. And my co-authors were a little bored. I said, we made 5% in 10 days. That's good. Let's not criticize. Then after that, we had the GameStop problem. And the GameStop problem we were caught short ball somewhere because you're long short. So that day, and we have also details that we can share with you. They're in the paper about what are the positions every day when we traded them. And you see that right after GameStop, we dropped 15% on the strategy, for more like easy 15%. And then I said, oh my God, this is over. But as soon as we pass this bad moment, the market recoups, bounces back up, and we went back to 105 and then continued, and we're currently a little bit above 15%. I think we're at 18% this morning. This is from last night. So uh, basically, it means that something is right. That is, when the market is doing its thing, we're mostly selling and buying volatility, but maybe we're a little bit risky because we have this expected utility that is too much of a short, whatever, maybe it's short term, or it's a short term or something. So we get taken here, but so was everybody else. It's not that I'm excusing myself, but I'm saying this is actually something good that happened because it allows us to then find out either not to put too much capital on something like this, or understand that the market in volatility derivatives is such that you can actually have very violent moves around events like GameStop and Robinhood and so forth. Yes. So in the end, I'm not giving you the whole paper, but you can read it. You're going to have a copy of it. And it's a lot of tables and a lot of numbers. But what it's basically saying is we used some sort of Markov model to forecast what we would do in terms of positioning in the market. And then we use a bit of neural networks to compute this function expected utility, right? And so based on that, we can sort of get an idea of what we would like to do, limiting the strategies to buying and selling the 1 month and the 5 month rolling futures, or ETF, which are the VXX and the VXZ. Then we put it to work, not only paper trading, but we put it to work recently in the period of GameStop and so forth. And we found that it gives you a decent results of there are unavoidable drops like the ones that we saw in the last chart. Simply now I can't find it as usual. Oops, this is something completely different. Yeah, it's very difficult to predict the future. So somehow our model still made us go from on the very violent period from January 26th, we recouped the money only on January 29. Well, no, on February 24th. So we had a month until we got past this drawdown. But the answer is more or less sell the front, buy the back, perhaps a bit more, and let the robot run it so you don't have to be, you get some kind of conviction, or you get a automatic way of doing this. And I think that I would like to stop here, and maybe if people want to ask questions, that's fine.
All right. There are a few questions in the chat that I'll read now, or I'll ask now. So the first question from Tobias Sichert. I am wondering, how are the returns to such strategies related to, or at least correlated with, the returns on variance swaps?
That's an excellent question, because the VIX is a variance swap. The VIX strategy, but excepting when you say variance swaps, the question is variance swap over what period? You're looking at a 1 month variance swap, that's VIX. It's a square of VIX. If you're looking at So here I was dealing with a 1 month variance swap, which is rolling, which is VXX, and a VXZ, which is the 5 month variance swap. And this looks much shorter scale than what people would use, say, in the OTC derivatives markets. But of course, these are the listed versions. Does that answer the question?
Well, so right now, I'd like to invite everyone to feel free to unmute yourself and answer your answer. Sorry, feel free to unmute yourself and ask your question with your microphone. The reason I said that as a preference, I don't know whether that answered the question, but I'll let Tobias jump in if he wants to ask a follow-up question.
I already found some interesting questions.
I'll let go ahead, Tobias. I'm sorry.
Alexander Carbonaro has a question in the chat.
Yes. So I'll let you read it. I don't since you see it, I won't read it.
Yeah, all your questions are perfect because these are questions that we discuss with our collaborators while we run the paper. One is, what's the motivation to maximize the utility over a one-step period? Could you approach use over fixed time horizon with multiple time steps? We can maximize the expected utility over the cumulative returns. What I would say to that is that I would like to have a longer time horizon, like in other papers. We did it, in my opinion, just because that was the easiest thing to do. But obviously, I would not like a one-day utility. I would like to have, there's nothing that, for that we need to use Monte Carlo, right? We need to generate Monte Carlo. So the easiest thing to do next, but of course these things, the way my collaborators do it, they do massive neural networks calculations that take forever. But I think that's very important to change that one-day utility into essentially a 1 month utility, since 1 month seems like the horizon for the VIX. That's the answer. Sorry, Tobias. What did Tobias say?
I had the question. Can you hear me?
Yeah.
Hi. Interesting talk. So I had the question on the variance swap. So if I understood correctly, you're short the 1 month and long the 5 month, right?
Correct, except that the VIX is not exactly the variance swap, but it's financially equivalent. It's economically equivalent.
Yes.
The VIX is a square root, right?
Yes, but what you do is not exactly the same as trading a variance swap, because that's then the VIX, the realized return is the VIX minus the realized variance times some notional.
Right.
But that has this typical pattern that you make small pennies in good times, and then you lose a lot of money in times of a crash. And so I have just the hunch that what you are doing with these huge drawdowns when the VIX spikes and otherwise you make a little bit of money is quite correlated with just trading a variance swap or selling a variance swap.
Yes, it is. But I'm selling a variance swap. But if you like, I also buy variance swaps. Obviously the question, when you look at vol trading since 2019 or 2018, or even before, the vol funds, they have to sell vol, right? So when you say I buy or sell variance swaps, all you're saying is I'm going to go short 1 month volatility or short 6 month volatility and so forth. That's how you make money, right? You sell premium and you make money, and one day you lose it all, or hopefully not. So the question is, what can I do not to lose it all? So that means that I have to buy variance somewhere else. If I allow, so am I sharing my screen with you now?
We're looking at a spreadsheet.
Yes, this spreadsheet gives me every day, these yellow and blue numbers are my positions, if you like, in the variance or in the VXX over different every day. So it says, for example, so if I go way back, I go way back. Initial position VXX 0 and final position on VXX. This is, I start 0 and then I end up selling 6. Then here I sell 6 here. These are these 6, and then I also So it's all VXX, right? So VXX, there's a lot of minuses, but then there's a position on VXZ, which is the 5 months, and this one is long, Tobias, right? So you sell VXX. Your idea is this: I want to make money. I'm sitting around. I'm going to sell insurance short term, and I'm going to hedge with long-term insurance. That's one idea. The other idea is different weights on the two. And then you start building a portfolio where you pick the best trade using selling vol, or you can either sell 1 month, buy 5 months, sell 1 month, sell all the combinations that I described. And so in reality, we are definitely have a vol selling problem. So does everybody else, because if you buy vol usually expires
Yeah, we might have a problem.
Well, for a minute I thought it was me, but we seem to have a connection problem.
Yes. It's very unfortunate to lose you like this, Marco, but nobody can hear you anymore. Well, on this techno beat that Marco is providing to us, I guess he's not hearing us anymore. So I guess I'll just then thank you all for attending. If Marco can come back, then I'll thank him for his insightful talk. But otherwise, well, Marco is gone. So thank you all for attending. We will have Yuran Wu in 2 weeks as our next.